This week, we are talking about our final chapter, which will be chapter 17, which is dealing with the analysis of financial statements. So we've been talking so far about balance sheets, income statement, statement of owner's equity, and cash flow statements. And then we were talking at the very beginning of the semester about how we journalize the transactions and then working up through how we create these. So now what we'll be talking about now is how as an accountant you can use your financial statements in order to determine the health of the organization. And some of you might end up maybe owning your own business. Maybe you'll own your own CPA firm, or maybe you will own some other kind of a business, and so you want to have a foundation for bookkeeping underneath you. And so what we're going to talk about today and this week will help you to understand, as a manager or as an owner, to understand the financial health of your business and to determine maybe if there's things that you might be able to do to change how you conduct the business in order to help it to grow and to prosper. We will explain the purpose and identify the building blocks of analysis. Financial statement analysis applies analytical tools to financial statements and related data for making business decisions. Internal users of accounting data manage and operate the business. Now, internal users are managers, officers, and internal auditors. The purpose of financial statement analysis for internal users is to provide information to improve efficiency and effectiveness in providing products and services. Now, external users of accounting information are not directly involved in running the company. They include shareholders, lenders, and suppliers. External users use financial statement analysis to make more informed decisions to pursue their own goals. So, for example, a shareholder might be interested in doing a little bit of analysis in order to determine if this is a company that they really want to invest in or not, or to determine, how the company might grow in the future. Lenders would be concerned in terms of if they should be lending money to this particular business and the business's ability to repay that money. Suppliers might be concerned with making sure, again, that they're going to be able to pay their bills. The company's going to be able to pay their bills and all of that. So internal and external users both will use analysis information for their own purposes. Now, the common goal of these users is to evaluate company performance and financial condition. These include evaluating the past and current performance, the current financial position, and future performance and risk. Financial statement analysis focuses on one or more elements of the four areas that are the building blocks of financial statement analysis: liquidity and efficiency, the ability to meet short-term obligations and to efficiently generate revenues; solvency, the ability to generate future returns and to meet long-term obligations; profitability is the ability to provide financial rewards sufficient to attract and retain financing; and market prospects is the ability to generate positive market expectations. Most users conduct analysis using general purpose financial statements that include the income statement, balance sheet, statement of stockholders' equity or statement of retained earnings, statement of cash flow, and notes in these statements. Financial reporting refers to the communication of financial information useful for making investment, credit, and other business decisions. Financial reporting includes not only general purpose financial statements, but also information from SEC 10K or other filings, press releases, stockholder meetings, forecasts, management letters, auditors' reports, and webcasts. Now we'll describe the standards for comparisons in analysis. When analyzing financial statements, we use the following standards or benchmarks for comparison. Intra-company. The company's current performance is compared to its prior performance and its relation between financial terms. For example, Apple's current net income, for instance, can be compared with its prior year net income and in relation to revenues or total assets. Competitor. Competitors provide standards for comparison. So for example, Coca-Cola's profit margin versus Pepsi's profit margin, or Jones Soda's profit margin. Those would be, you could compare against competitors in the same industry. Or an example for Apple, competitors for Apple Computer might be Hewlett Packard, might be Dell, might be Google because of the phones and things, or Samsung, LG, because they manufacture cell phones and electronics as well. Industry. Industry statistics provide standards of comparison. So Intel's profit margin can be compared to its industry's profit margin. So Intel makes chips. There are AMD makes chips. National Semiconductor, they make chips. There's a lot of different companies that are in that same industry, and so you can compare across industries. Now, guidelines, a rule of thumb. Standards of comparison can develop from experience. Examples are the 2-to-1 level for current assets, or the 1-to-1 level for the acid test ratio. Benchmarks from a competitor or a group of competitors are often best. Intercompany and industry measures are also important. Guidelines and rule of thumbs should be applied with care, and then only if they seem reasonable given past experience and industry norms. So some different tools for analysis is we have horizontal analysis. That is a comparison of financial condition and performance across time. A vertical analysis is a comparison of financial condition and performance to a base amount. And then ratio analysis is the measurement of key relations between financial statement items. We'll explain and apply methods for horizontal analysis. Horizontal analysis is the review of financial statement data across time. Horizontal comes from left to right or right to left movement of our eyes as we review comparative financial statements across time. Comparing financial statements is done by analyzing dollar amount changes and percent changes in line items. Both analyses are relevant because dollar changes can yield large percent changes inconsistent with their importance. A 50% change from a base figure of $100 is less important than the same percentage change from a base figure of $100,000 in the same statement. We compute the dollar change of a financial statement item as shown on this slide. And so we do that by taking the analysis period amount, subtracting from the base period amount. Now, the analysis period amount refers to the financial statements under analysis, and the base period refers to the financial statements used for comparison. The prior year is commonly used as the base period. We compute the percent change by dividing the analysis period amount minus the base period amount by the base period amount and then multiplying by 100. So the percent change is the analysis period amount, and then we subtract the base period amount divided by the base period amount multiplied by 100 to get it into a percentage. Comparative balance sheets. Analysis of comparative financial statements begins by focusing on large dollar and percent changes. We then identify the reasons and implications for these changes. We also review small changes when we expected the change to be large. Exhibit 17.1 shows comparative balance sheet for Apple Incorporated, NASDAQ symbol AAPL. A few items stand out on the asset side. Apple's short-term marketable securities increased by 15.5%, and its long-term marketable securities increased by 14.2%. This combined for a large 31.505 million increase in securities. In response, Apple raised its dividends and plans to spend at least $210 billion buying back stock by the end of the next year. Dividends and share repurchase plans are likely to slow its growth of short-term securities because it has, well, so what happens with Apple is Apple obviously holds a lot of cash. Rather than holding it in cash, they put it into short-term securities. So what they would do then is, rather than holding the short-term securities, they'd rather repurchase stock, and then also so that there's less shares outstanding, which increases the value of their stock, and then they would also like to pay their shareholders higher dividends as well with that cash. Now, other notable increases occur with property, plant, and equipment and inventories, which are a high percentage increase but relatively small dollar increase. On Apple's financing side, we see its overall 16.7 increase is driven by a 24.7 increase in liabilities. Equity increased only 4.5%. The largest increase is for long-term debt, which increased by 21,780 million, or 28.9%. Much of this increase results from bond offerings by Apple to take advantage of the low interest rates. We also see a modest increase of 2%, 1,966 million, in retained earnings, which consists of strong income of 48,351 million, which is reduced by cash dividends and stock repurchases. So again, they're taking advantage of the low interest rate environment by, again, borrowing more money so that they can use that in order to invest in new equipment or new processes, or to be able to invest in maybe some R&D to be able to develop some new technologies that they can use in their products. And they're doing pretty well. Now, comparative income statements are prepared similar to the comparative balance sheet we spoke of previous. So Apple's comparative income statements. Apple reports an increase in sales of 6.3%. Cost of sales increased to a greater extent than sales, 7.4%, which is not a positive sign. So they did increase sales, but it's costing them more in order to garner those sales. So you have to look at then, why is that? So where are their sales coming from? Are they coming from retail? Are they coming from online? Are they coming from maybe alliances that they have with the cell phone carriers like AT&T and Verizon and all of that? You'd have to look at what's driving the cost increase in the cost of sales. Now, the 10.7% increase in operating expenses is primarily driven by the 15.3% increase in research and development costs, from which management and investors hope to reap future income. And we can speculate as to why where they might be spending that income on. While Apple's net income increased just 5.8%, its basic earnings per share increased 11%. This is largely due to their share buyback. But Apple's spending a lot of money in R&D. Obviously, they're coming out with new cell phone models. I know they just came out with that, but also now in their laptops and their computer sector, they're now spinning their own silicon now. So you've heard of the I think it's the M1 processor now. So Apple now makes the processor, the CPU that's in their computers now. Instead of using, before it was PowerPC, and then they went to Intel. Now they're spinning their own silicon. Well, they had to probably invest quite heavily in R&D in order to be able to develop that. So that's why the R&D cost increased. Trend analysis. Trend analysis involves computing trend percent that shows patterns and data across periods. Trend percentage is computed as the analysis period amount divided by base period amount times 100. So we'll look at an example of this with Apple. These data are from Apple's current and prior financial statements. The base period is the number reported 4 years ago, and the trend percentage is computed in each subsequent year by dividing that year's amount by the base period. For instance, the net sales trend percent for the current year is 134.1%, computed as and 229,234 divided by 170,910. The trend percents using data from figure 17.3 are shown in figure 17.4. These are the data, and then we see the percentage, current year, and so we see that their net sales each year have increased. The base year would have been 4 years ago, and so then it increased 7%, 36%, 26%, and then 34%. The cost of sales we see, and then the operating expenses, we see how that's changing. So this allows you to see changes over time. This slide shows the trend percents from the prior slide in a line graph. That helps us to identify trends and detect changes in direction or magnitude. Apple's net income will suffer if expenses rise faster than sales. So we see the sales is the blue, the red is the cost of sales, and then the green is operating expenses. We see operating expenses continue to increase very quickly, whereas the sales and cost of goods, they're rising too, but not at the same rate as the operating expenses are. So now we will describe and apply methods for vertical analysis. Vertical analysis, also called, and you'll see this in our book, it's called a common size analysis, is used to evaluate individual financial statement items or a group of items in terms of specific base amount. The term vertical analysis arises from the top to bottom or down up movement of our eyes as we review common size financial statements. We use common size financial statements to reveal changes in the relative importance of each financial statement item. All individual amounts in common size statements are redefined in terms of common size percents. A common size percent is calculated as the analysis amount divided by the base amount times 100. Common size statements express each item as a percent of the base amount, which for a common size balance sheet is total assets. The base amount is assigned a value of 100%. So total liabilities plus equity also equal 100%, since this amount equals total assets. We then compute the common size percent for each asset, liability, and equity item using the total assets as the base amount. Exhibit 17.8 shows common size comparative balance sheets for Apple. Some relations that stand out on both a magnitude and percentage basis include a new issuance of long-term debt, a 2.5% increase from 23.4 to 25.9, the largest of any liability, and two, a 3.8% decrease in retained earnings and a 1% decrease in cash and cash equivalents, largely the result of cash dividends and stock buybacks. The absence of other substantial changes in Apple's balance sheet suggests a mature company, but with some lack of focus is evidenced by the large amount for securities. This buildup in securities is a concern as the return on securities is historically smaller than a return on operating assets. Time will tell whether Apple can continue to generate significant revenue and income from its expanding asset base. So it would be more beneficial for Apple to use their money in order to grow the company. So either to make new products or to make new ways that they might be able to sell the products, etc. But they're kind of at a state, they're at a mature company. And obviously we know the types of things that Apple makes. They make the iPad, they make the iPhone, they make the various laptops, and they still do make desktop computers as well. But they haven't really come out with anything really that new and that different from what they've done in the past. Obviously they make changes, every year they release a new phone. As I say, they just released the new thing with their computers now on the hardware side with them, but they would make more money by innovating versus just holding, stocks and bonds and other types of investments. And so you have to look at that, and the company then, do they have the focus in order to be able to continue? I mean, they're going to continue on in the future, but time will tell how that will be. Now, the common size income statement analysis also benefits from use of the common size income statement. Revenue is the base amount, which is assigned a value of 100%. Each common size income statement item appears as a percent of revenue. If we think of the 100% revenue amount as representing one sales dollar, the remaining items show how each revenue dollar is distributed among costs, expenses, and income. Figures 17.9 show common size comparative income statements for each dollar for Apple's net sales. The past 2 years' common size numbers are similar with two exceptions. One is the increase of 0.4 cents in research and development costs, which can be a positive development if those costs lead to future revenues, which it seems like they might. Another is the increase in cost of sales of 0.6 cents and the increase in selling, general, and administrative costs of 0.1 cent. We must monitor the growth of these expenses. Exhibit 17.10 is a graphic of Apple's current year common size income statement. This pie chart shows the contribution of each cost component of net sales for net income. The first one here, 17.10, is the common size graphic of the income. So you see the cost of sales, and then again, their net income is the orange, and how much income taxes, everything. So this shows you then for every dollar of sales, basically, how that is divvied up. Now, the assets you can see here, this shows you the component of the assets and where their assets are. So we see cash and cash equivalents is 5%, short-term securities 14%, 5% of accounts receivable. Inventory is 1%. They're very lean on inventory. They don't hold a lot of inventory. So they do a lot of just-in-time inventory. So like, for example, if you were to order a laptop, they build it pretty much for you. They don't just have it necessarily on the shelf. They maybe have a few. Same thing with, their phones and all of that. They're pretty lean in terms of that. Their vendor non-trade receivables, etc. Long-term marketable securities is huge, 52%. So that's where most of their money is in terms of their assets. So this is important because that gives you an idea for the assets and how that breaks down for the company. So we'll define and apply ratio analysis. Ratios are used to uncover conditions and trends difficult to detect by inspecting individual amounts. A ratio shows a relation between two quantities. It can be expressed as a percentage, a rate, or a proportion. For instance, a change in an account balance from $100 to $250 can be expressed as 150% increase, 2.5 times, or 2.5 to 1. This section describes important financial ratios. The ratios are organized into 4 building blocks of financial statement analysis: liquidity and efficiency, solvency, profitability, and market prospects. We use 4 common standards for comparison: intra-company, competitor, industry, and guidelines. Okay, so liquidity and efficiency. Liquidity is the availability of resources to pay short-term cash requirements. It is affected by the timing of cash inflows and outflows, along with prospects for future performance. Efficiency is how productive a company is in using its assets. So these are some various ratios that you can use to determine the liquidity and the efficiency of a company. So the current ratio, the asset test ratio, the accounts receivable turnover, the total asset turnover, the days sales inventory, days sales uncollected, and the inventory turnover. Now, all of these ratios we've worked with a little bit as we've been going along throughout the course, and so now we're kind of just bringing this all together. Okay, working capital. The amount of assets less current liabilities is called working capital, or net working capital. A company that runs low on working capital is less likely to pay debts or to continue operating. And so more working capital suggests a strong liquidity position and ability to pay debts and to continue operating. So for example, for Apple, we've been looking at they obviously have very high working capital. So if something happened, they would be able to come up with the money. So for example, right now with what's happening, kind of to bring this kind of into focus, right now we all know that we're going through this worldwide pandemic of coronavirus, of COVID-19. Well, unfortunately, right now, and like especially even here locally in Merced County, a lot of our businesses have either closed down or they have had to change how they do things. So a lot of our restaurants now went to drive-through, delivery, and curbside. A lot of our other businesses, for example, a lot of the hair salons and stuff, they all had to close down. Or they maybe are allowed to work outside. I don't know. But obviously now that it's starting to get a lot chillier now during the day, they're not going to want to work outside or be able to. A company that doesn't have good working capital, it's going to be, obviously the day-to-day is going to be difficult, but obviously right now when you're hit with something like this, it's going to be very hard for them to stay open. Your places like Walmart, your places like Save Mart, your places like Apple, we've been discussing Apple, they're going to be okay and they're going to weather the storm. And obviously then things happen, kind of a side note, but like with Apple, everybody's working from home, and so everybody needs computers and needs devices. And so obviously Apple's working to provide, those to people, as well right now. But that's a side note, but working capital is important because if a company doesn't have the money to pay wages and pay debts and to pay for things, then it's going to be very difficult to continue on. Current ratio. When evaluating a company's working capital, we must not only look at the dollar amount of current assets less current liabilities, we also have to look at their ratio. The current ratio is defined as shown. And so the current ratio is the current assets divided by the current liabilities. A high current ratio means a strong ability to meet current obligations. And an excessively high ratio means that the company has invested too much in current assets compared to its current obligations. So again, if that current ratio gets too high, they're hoarding cash and current assets, and maybe they could and should look at maybe doing something else with them that might be better and more beneficial to the company long term. An excessive investment in current assets is not, as I say, not an efficient use of funds, because current assets normally generate a low return of investment compared to long-term assets. Many analysts use a guideline of 2.1 or 1.5 to 1 for the current ratio. A 2 to 1 or higher ratio is considered low risk in a short run. Analysis of the current ratio must consider the type of business, the composition of current assets, and the turnover rate of current asset components. Now, the acid test ratio. Quick access to cash, short-term investments, and current receivables. These are the most liquid types of current assets. The acid test ratio, also called the quick ratio, and as we talked about in Chapter 5, reflects on a company's short-term liquidity and is shown here. And so we see that the acid test ratio is cash plus short-term investment plus current receivable divided by the current liability. Again, this would be just those assets that we could turn very quickly into cash, either that are already cash or we could turn into cash that are highly liquid. So as with analysis of the current ratio, we have to consider other factors. How frequently a company converts its current assets into cash also affects its ability to pay current obligations, obviously. This means analysis of short-term liquidity should consider receivables and inventories. And so kind of a silly example, but if I think about, thinking about on a micro, my dental office where I go and get my teeth cleaned and fixed. They allow me to have a receivable there where I'm going to keep paying them for my bill. I don't have to come up with all that at once. Well, how quickly I pay that has an impact on them, and of course not just me but all of their patients, right? If their patients, if they did all this dental work and they accepted a promise to pay but nobody ever paid their bill, they would run out of money right quick to be able to pay their PG&E, to pay their utilities, to pay their salary, for the dentist himself to get paid, etc. Right? So it's important that you turn these things, these current receivables have to be turned over fairly quickly, because if they're not, it's going to affect them being able to pay their bills, which kind of goes into the next thing, which is our account receivable turnover. So account receivable turnover measures how frequently a company converts its receivables into cash. Accounts receivable turnover is high when accounts receivables are collected quickly. A high turnover is favorable because it means the company doesn't have to tie assets in accounts receivable. However, accounts receivable turnover can be too high. This occurs when credit terms are so restrictive that it decreases sales. So you want to give people credit, you want, because that helps people to spend more money. But at the same time, you don't want to be so restrictive that you're not granting credit, because then that turns people away, depending upon what type of business you have. And again, the accounts receivable turnover is calculated as net sales divided by the average accounts receivable net. Inventory turnover. Inventory turnover measures how long a company holds inventory before selling it. A company with a high turnover requires a smaller investment in inventory than one producing the same sales with a lower turnover. Inventory turnover can be too high, however, if the inventory is so low that stockouts occur. And that can be a challenge as well. So for example, for Apple, if they're doing really well, they don't want to hold inventory for too long. For example, what good would it be if, for example, my cell phone that I have is an Apple iPhone 5S? Well, obviously that's long out of date. What good would it be for Apple to have a huge inventory of those phones? They're no longer in demand. They're worthless to them. Okay. It would do them no good. But you also don't want to have so many, let's say with the new iPhone that came out, if they didn't have enough of them to go around, they could possibly lose out on sales. And so that's the kind of, you have to strike a balance of thinking about your inventory. You want to have enough so that you're selling it. It's good, but you also don't want to have too much inventory where it's either going to become obsolete or it will deteriorate. So for example, at the grocery store, the bread and the milk and the eggs and things like that, spoilage, and the vegetables and stuff, spoilage is a huge problem, right? So that's an issue. Or if you're thinking about electronics, we realize, unfortunately, that the pace of electronics is one area that changes extremely, extremely rapidly. So you don't want to have a huge inventory and then not be able to get rid of it, and then it becomes obsolete. So again, just thinking about that. Even with like the clothing stores, they have to think about that because seasonality. And obviously they don't want to have, all of the summer clothes, and they don't want to be selling that in a winter. And obviously the following spring and summer, they're going to want to bring in new styles. So again, just thinking about how this is, and you have to strike a very difficult balance with how much inventory you have. And then again, how quickly you're turning this over. The days sales uncollected. Days sales uncollected measures how frequently a company collects accounts receivable. Days sales uncollected is more meaningful if we know the company's credit terms. A rough guideline states that days sales collectible should not exceed 1 1/3 times the days in either the credit period if discounts are not offered, or the discount period if favorable discounts are offered. And so the days sales uncollected is the accounts receivable net divided by net sales multiplied by 365. Days sales and inventory. Days sales and inventory, kind of going back to what we talked about previous, is a useful measurement in evaluating inventory liquidity. If a product is demanded by customers, this formula estimates how long it will take to sell that inventory. So it's the ending inventory divided by the cost of goods sold multiplied by 365. And so that helps you to figure out how long it was going to take to sell that. And so again, depending upon what it is, that's going to depend upon then how much inventory you're going to have and how you would operate that. Now, the total asset turnover. Total asset turnover measures a company's ability to use its assets to generate sales and reflects on operating efficiency. And so this is net sales divided by the average total assets. A little bit about solvency. Now, solvency is a company's long-run financial viability and its ability to cover long-term obligations. Analysis of solvency is long-term and uses more encompassing measures than liquidity. An important part of solvency analysis is the company's capital structure. And the capital structure refers to the company's makeup of equity and debt financing. So again, some ratios that you would use to figure out solvency are the debt ratio, the equity ratio, the debt to equity ratio, and the times interest earned. Debt ratio and equity ratio. One element of solvency analysis is to analyze a company's mix of debt and equity financing. The debt ratio shows total liabilities as a percent of total assets. The equity ratio shows the total equity as a percent of total assets. Apple's debt and equity ratios are shown on this slide. Apple's ratios reveal more debt than equity. A company is considered less risky if its capital structure, equity plus debt, has more equity. Debt is considered more risky because of its required payments of interest and principal. Stockholders can't require payment from the company. However, debt can increase income for stockholders if the company earns a higher rate of return than interest paid on the debt. Debt to equity ratio. The debt to equity ratio measures solvency and is computed as the total liabilities divided by the total equity. Debt must be repaid with interest. While equity does not, debt payments can be burdensome when the industry or the economy experience a downturn. And so, for example, again, right now with what's happening, or even with what happened in 08 and 09, if you remember that, but certainly what's happening right now with this coronavirus pandemic. When something like that happens, and again, nobody could have foreseen that this was going to happen. This is a once in 100-year pandemic. We don't experience these things, fortunately, often. But when something like this does happen, and then you have to make payments and debt service, it's going to be hard for companies to survive. And right now, with what's going on, it's going to be very difficult for a lot of companies to survive, potentially, this. The times interest earned. Times interest earned is the amount of income before subtracting interest expense and income taxes is the amount available to pay interest expense. The following times interest earned ratio measures a company's ability to pay interest. So times interest earned is the income before interest and taxes divided by the interest expense. The larger this ratio, the less risky is the company for creditors. One guideline says that creditors are reasonably safe if the company has a ratio of 2 or more. And now, different measures of profitability. Profitability refers to the company's ability to generate an adequate return on invested capital. Return is judged by assessing earnings relative to the level and source of financing. Profit margin. Profitability is the company's ability to earn an adequate return. Profit margin measures a company's ability to earn net income from sales. To evaluate profit margin, we must consider the industry. For example, an appliance company might require a profit margin of 15%, whereas a retail supermarket might require a profit margin of 2%. And that's really quite striking when you think about it. So like, for example, the grocery stores and Walmart and all of that, they might only have a profit margin of 2%. Again, they're doing a lot more sales in terms of volume and possibly dollar amount, depending upon what it is, if it's a chain of them. But again, thinking about that, and that's why, because the profit margin, for example, for a grocery store is so small, or for a place like Walmart is so small, that's why they have to really look at their costs. They have to look at making sure, their inventory isn't walking out of the growing legs and walking out of the door, without being paid, etc. So that's like what's happened right now with like Walmart around here, is everything is being locked up, and they have, turnstiles, they have all these things, because they've been losing a lot of product. And when people use a 5-finger discount and merchandise is walking out the door unpaid, it has an impact. And especially for something, as I say, like a grocery store where they may only have a profit margin maybe of 2%, then that makes a huge difference. The return on total assets. Return on total assets is defined as net income divided by average total assets. And so we can determine the return a company earns on its total assets. To calculate this ratio, we divide net income by the average total assets for the period. Return on total assets measures how well assets can be employed by the company's management. Return on common stockholders' equity. Return on common stockholders' equity measures a company's ability to earn income from common stockholders and is computed as net income minus preferred dividends divided by the average common stockholders' equity. The denominator in this computation is the book value of common equity. Dividends on cumulative preferred stock is subtracted from income, whether they are declared or are in arrears. If preferred stock is non-cumulative, its dividend is subtracted only when it's declared. And then finally, market prospects. And again, different ratios that you can use would be the price earnings ratio and the dividend yield. Market measures are useful for analyzing corporations with publicly traded stock. These market measures use stock price, which reflects the market's or public's expectations for the company. This includes expectations of both company return and risk as the market perceives it. Key measures of market prospects include the price earnings ratio and a dividend yield. Price earnings ratio. And this is calculated by the market price per common share divided by the earnings per share. So computation of price earnings ratio measures market expectations for future growth. Dividend yield is used to compare the dividend paying performance of different companies. It is computed as annual cash dividends per share divided by market price per share. Some companies, such as Google, do not pay dividends because they reinvest the cash to grow their businesses in the hope to generate greater future returns and dividends. And in this slide summarizes the major financial statement analysis ratios illustrated in this chapter and throughout the book. This summary includes each ratio's title, its formula, and the purpose for which it's commonly used. And I know that you see it here on your screen, but you can also, in your textbook, you have it. And there should be a chart also in the appendices also that lists these. So now we'll summarize and report the results of analysis. A financial statement analysis report usually consists of 6 sections. The executive summary, which is a brief analysis of results and conclusions. The analysis overview is the background on the company, its industry, and the economy. Evidential users is the financial statements and information used in the analysis, including ratios, trends, comparisons, and all analytical measures used. Assumptions list all assumptions regarding a company's industry and economic environment and other assumptions underlying estimates. Key factors list favorable, unfavorable factors, both quantitative and qualitative, for company performance, usually organized by areas of analysis, inferences, forecasts, estimates, interpretations, and conclusions of the analysis report. We must remember that the user dictates relevance, meaning that the analysis report should include a brief table of contents to help readers focus on those areas most relevant to their decisions. All irrelevant matter must be eliminated. For example, decades-old details of obscure transactions and detailed miscues of the analysis are irrelevant. Ambiguities and qualifications to avoid responsibility or hedging inferences must be eliminated. Finally, writing is important. Mistakes in grammar and errors of fact compromise the report's credibility. We will explain the form and assess the content of a complete income statement. Sustainable income. When a company's activities include income-related events not part of its normal continuing operation, it must disclose information about these events. To alert users of these activities, companies separate the income statement into continuing operations, discontinued segments, comprehensive income, and earnings per share. The separations of discontinued segments, comprehensive income, and earnings per share from continued operations helps us to measure sustainable income, which is the income level most likely to continue into the future. Sustainable income is commonly used in performance measures. Continuing operations section 1 shows revenue, expenses, and income from continuing operations. This information is used to predict future operations, and most view this section as the most important. Gains and losses that are normal and frequent are reported as part of continuing operations. Gains and losses that are either unusual and or infrequent are reported as part of the continuing operations, but after the normal revenues and expenses. Items considered unusual and or infrequent include property taken away by a foreign government, the condemning of property, the prohibiting use of an asset from a new law, losses and gains from an unusual or infrequent calamity, such as an act of God. And so that would be an example of an act of God, might be a tornado or an earthquake or the coronavirus, something like that. It's something that is either a gain or a loss, something that's very unusual, very infrequent. And the financial effects of labor strikes. Now, 2, discontinued segments. A business segment is a part of a company that is separated by its products or services and or geographic location. So some companies, they organize based on the area. So for example, they might separate their operations into the North American, South American, Europe, Asia, Africa regions, or they might base it based on the types of products that they have. So for example, PepsiCo, they sell obviously soft drinks, sodas, but they also sell energy drinks, they sell other things, but they also, I believe they also own Frito-Lay, so the chips and snacks. So that's a separate segment. Maybe they might also, based on, like for the soft drinks, it might be based on their bottling, which is what we buy like at the store out of a vending machine, versus what they sell, the syrup and everything, what they sell for like restaurants and food service. So they might separate out based on the type of business that they do. Different ways that you might segment out a business. So now a segment has assets, liabilities, and financial results of operations that can be separated from those of other parts of the company. A gain or loss from selling or closing down a segment is separately reported. Section 2 of Exhibit 17A1 reports both income from operating and discontinuing segment before its disposal, and the loss from disposing of the segment's net income. The income tax effects of each of the are reported separately from the income tax expense in the section. Now, earnings per share, section 3 of Exhibit 17A.1 reports earnings per share for both continuing operations and discontinued segments, where they both exist. Earnings per share, we talked about that back in chapter 13. Now, changes in accounting principles. Changes in accounting principles require retroactive application to prior periods' financial statements. Retrospective application means applying a different accounting principle to prior periods, as if that principle has always been used. Retrospective application enhances the consistency of financial information between periods, which improves the usefulness of the information, especially, again, when you're doing your comparative analysis. Because if something changed currently, you didn't go back and restate it in your prior financial statements, it's going to make it very difficult, if not impossible, to and make it irrelevant to be able to compare the numbers across time.